All right, let's just get right into it. I made one mistake, one click of a button, and it cost me thousands and thousands and thousands of dollars. This is the story of the single dumbest trade I have ever made in my entire life, and exactly how you can avoid repeating my very expensive, very painful financial faceplant. Trust me, you're going to want to stick around for this one. And hey, if you get any value from my public humiliation, do me a favor and hit that subscribe button. It's free and it makes the pain a little more bearable. Now, let's get into it.
Okay, so picture this. The scene? It's November 2022. The entire crypto market was in an absolute gravity-defying freefall. I mean, just look at this chart. This wasn't a dip. This was a nosedive off a skyscraper, straight into a volcano. We're talking pure, unadulterated chaos.
And right there, at the absolute peak of the panic, with these terrifying red candles flashing everywhere, I did it. I smashed the sell button. My portfolio didn't just go down, it got vaporized. It was, without a shadow of a doubt, the single worst trade of my entire life. So, what on earth was going on? How did a massive $8 billion implosion in the market trigger the single dumbest moment of my financial life? Let's break it down.
It all kicked off with this one company, FTX. For a little while there, they were one of the biggest, most trusted crypto exchanges in the entire world. But behind the scenes, it was a complete house of cards. They ran out of money, customer funds just vanished, and the whole thing collapsed, which triggered this tidal wave of panic across the entire industry.
But here's the thing, right? FTX collapsing doesn't fully explain why I made such a catastrophic decision with my own money. For that, we need to perform an autopsy, not on the market, but on my own brain.
You know, in old-school economics textbooks, they have this idea of the perfect investor. They call him Homo economicus. He's basically a robot. He sees a market crash, calmly analyzes all the data, and makes the perfectly logical move. And then, well, then there was me back in November 2022. A panicking human fueled by way too much coffee and just sheer terror. Definitely not a robot.
The hard truth is, our brains were not designed for the 24/7 chaos of crypto markets. When things get crazy, our wiring just kind of short circuits. We have glitches. And in the world of investing, those glitches are incredibly, incredibly expensive. So let's put my boneheaded panic sale under the microscope. Let's identify the exact mental glitches that made me decide it was a good idea to light a giant pile of my own money on fire. Okay, glitch number one is a classic. It's called herding behavior. It's that ancient lizard brain instinct that tells you, hey, everyone else is running and screaming, so I should probably run and scream too, even if you have absolutely no idea why. In the market, that means selling just because everyone else is selling.
Now, what's really fascinating here is you can actually see the herd in the data. This insane spike in volatility right here, that's the signature. It's the sound of millions of investors, myself included, all stampeding for the exits at the exact same time. It's terrifyingly beautiful in a way.
Glitch number two is a little more subtle. It's called the salience heuristic. This is the, oh my God, the headline is huge and scary glitch. Our brains are hardwired to overreact to vivid, shocking news, like $8 billion collapse, and completely ignore the boring context or what it really means for our own personal investments. Okay, so I messed up. Big time. I panicked. I lost a lot of money. But that disaster forced me to build a system to protect my portfolio from, well, to protect it from myself. This is my redemption arc. These are my never-again rules. It's a pretty simple 4-step firewall. First, create an actual plan before the panic starts. Second, automate that plan so I can take my emotional, glitchy brain out of the driver's seat. Third, diversify everything. And fourth, this is the big one that would have saved me. Control your own keys. So, here's the nuts and bolts. Rule 1 forces me to think in years, not in hours. Rule 2 automates the whole thing with something called dollar cost averaging, or DCA. So instead of trying to time the market like a genius, which I'm clearly not, I now automatically buy, say, $50 of crypto every single week, no matter what the price is. It averages out my cost and keeps my panic-prone fingers off the buttons. And Rule 3 is just smart. Don't put all your eggs in one basket, so one disaster can't sink the whole ship.
But honestly, those rules are just the warm-up act. The single most important rule, the one that would have made the entire FTX collapse a complete non-event for my personal portfolio, is this next one.
And this table just lays it all out perfectly. On a centralized exchange, a CX like FTX was, they control your crypto.
They have the keys. So when they went bankrupt, the money they were holding just went with them. Poof. But with a decentralized exchange, a DEX, or even better, your own hardware wallet, you use what's called self-custody. And that means you control the keys. You are your own bank. FTX could collapse 100 times over and it wouldn't touch a single cent of my funds.
So these rules, they're not just an investment strategy. They are a psychological firewall. I designed it specifically to protect my future self from my present self's inevitable moments of weakness and, let's be honest, panic.
Look, my little brain glitch back in November 2022 cost me thousands of dollars. But for you, watching this right now, this lesson is completely, totally free.
So I'll just leave you with this one question. The next market crash isn't a matter of if, it's really just a matter of when. And when it finally arrives, are you going to be calmly following a plan that you already made, or are you just going to be another member of the herd running straight for the cliff?